Hi, and welcome back to the Food Fund, where we analyze investing in amazing food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. In this video we will be evaluating the portfolio performance, discussing the portfolio composition, and revealing the brand new stock that I added to the portfolio. So be sure to watch through the end of the video. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, cue the logo. Let's start off with the market's performance. For the month of October, the S&P 500 returned -0.1%. The market again hit all-time highs in the middle of the month, but the share price has since begun to fall. Here we can see that the S&P 500 had a mediocre month. Big tech companies like Nvidia and Alphabet gained, while Apple, Meta, and Amazon largely remained neutral, and Microsoft fell. Over in our corner of the market, non-alcoholic beverage, farm products, alcoholic beverage, confectionery, consumer packaged foods, and restaurant companies all fell. Spoiler alert, it was a painful month for the portfolio. October also had several big restaurant earnings reports. McDonald's double beat with earnings per share coming in at $3.23 versus expectations of $3.20, while revenue was $6.87 billion versus expectations of $6.82 billion. Chipotle beat on earnings per share, achieving 27 cents versus expectations of 25 cents, but missed on revenue, which came in at $2.79 billion versus $2.82 billion expected. Wingstop missed on earnings per share, achieving 88 cents versus expectations of 95 cents, but beat on revenue, which came in at $162.5 million versus $159.9 million expected. Last, Starbucks missed on both earnings per share, achieving 80 cents versus expectations of $1.03, and revenue, which came in at $9.07 billion versus $9.36 billion expected. Okay, let's move on to the portfolio performance. I deposited $100 into the account on the 1st of October, 2024, and at the end of the month the portfolio balance was $402.41. This means the portfolio was down $2.68 for the month, representing a -0.7% return for October. Given the S&P 500's -0.1% return, we lost 0.6% of alpha by not being invested in the S&P 500. Better than last month, but still not good. Since inception, the portfolio has had a 0.3% return on a money-weighted basis, while the return on a time-weighted basis was 0.6%. Given the S&P 500's 4.2% return, we lost 3.9% of alpha by not being invested in the S&P 500 since the portfolio's inception. While I am happy that we are in the black, we do trail the S&P 500 by a significant amount. Hopefully the new position I started will help us get back on track. Now let's look at the portfolio moves for the month. First, I bought some more Celsius on the 3rd of October and 4th, while also adding to my Dutch Bros position on the 4th of October. The 7th of October and 16th saw me buy more Celsius, with some Hershey on the 16th. On the 17th of October and 21st I continued to average down in Celsius and bought both Celsius and Hershey on the 22nd of October. The 23rd of October and 25th brought more Hershey buys, and on the 29th of October I bought more of the dip in Hershey and Celsius. On the 30th of October I bought more Celsius and took advantage of the post-earnings dip and started a position in Wingstop. We will discuss this a bit later in the video. To finish out the month I bought more Celsius and Wingstop the 31st of October. Okay, let's take a closer look at each holding. Celsius is now my largest holding, with 3.74 shares at a cost basis of $35.99. This position is down 16.4%. Celsius makes up a ridiculous 28% of the portfolio. I have been aggressively averaging down into this position for a couple of reasons. Celsius has the best fundamentals and valuation out of all the companies in my portfolio. There literally aren't any better companies. Additionally, I think that the share price has found some semblance of a support. I hope I'm not wrong. Going forward I still plan to average down, but perhaps less aggressively, as I now have some other positions where I can buy the dip instead. Pepsi is my second largest holding, with 0.41 shares at a cost basis of $167.89. This position is down -1.1%. Pepsi makes up 17% of the portfolio. I added to my position in Pepsi last month and actually raised my cost basis. Again, I think it is a key anchor for my portfolio and may add to it if it falls more. Chipotle is my third largest holding, with 1.1 shares at a cost basis of $49.67. This position is up 12.3%. Chipotle makes up 15.3% of the portfolio. I have not added to this position since taking advantage of the aftermath of Brian Niccol leaving for Starbucks. The recent post-earnings dip was not enough of an opportunity for me and I decided to put money to work elsewhere for now. Next, Texas Roadhouse, with 0.24 shares at a cost basis of $165.72. This position is up 15.3%. Texas Roadhouse makes up 11.2% of the portfolio. Though the valuation is second best only to Celsius out of the companies in my portfolio, I just have not been keen on adding to this position with the share price so high. I don't expect any pullback soon and this stock will likely keep chugging away. Now we have the new addition, Wingstop, with 0.13 shares at a cost basis of $295.54. This position is down 2.7%. Wingstop makes up 9.3% of the portfolio. Wingstop is a stock I have lusted after for a long time. Its gross margin is amazing. Revenue and free cash flow growth are both solid and it has the second best return on invested capital in my portfolio. So after seeing the share price dive after good earnings, I decided to open a small position and place some limit orders to buy if the share price fell. Well, the share price continued to fall and I accumulated a nearly 10% position. While the 20% pullback feels like a good time to start a position, I expect more downside and plan to average down. Next, we have Hershey, with 0.19 shares at a cost basis of $182.25. This position is down 2.6%. Hershey makes up 8.4% of the portfolio. Hershey is clearly not a growth stock, but I was aggressively looking for places to invest and the pullback provided an opportunity. Now that I have companies with better fundamentals currently in drawdowns, I will look away from Hershey to invest in the near term. Now, we have the sushi restaurant Kura Sushi, with 0.19 shares at a cost basis of $52.09. This position is up a whopping 91.6% and is clearly my best performing position. Kura Sushi makes up 4.7% of the portfolio. I have not added to this position, though I wish I had in retrospect. I think the value proposition for Kura Sushi customers remains intact, though their upcoming earnings will provide a much needed update. I have no current plans to add to this position. Next we have Starbucks, with 0.13 shares at a cost basis of $75.07. This position is up 30.1%. Starbucks makes up 3.3% of the portfolio. I think the new CEO Brian Niccol is an excellent choice to lead the company into the future. However, there is still a lot of work to do in order to turn this company around. I plan to continue to hold this company and will add on major drawdowns. Now we have the penultimate position, Dutch Brothers, with 0.34 shares at a cost basis of $29.73. This position is up 11.4%. Dutch Bros makes up 2.8% of the portfolio. Though I averaged up a bit, I still really like Dutch Brothers. Unfortunately, the stock really took off before I could build a bigger position. I would not mind adding to this position on a pullback. Last, I did a very good job investing this month and have less than 0.1% in cash that we will carry over to next month and also earn interest on. In regards to the portfolio metrics, I was able to improve performance in every category compared to last month, with the exception of yield on cost. The largest improvement came in the revenue and free cash flow growth. I really like the companies in my portfolio and may consider adding just one more if the price comes down. The challenge now will be adding strategically to these positions while keeping valuation in mind. The natural inclination is to buy the dip of the companies in the portfolio, but doing so is literally watering the losers. The good news is that we have more earnings coming up in November, so there should be plenty of opportunities to add to positions with large price dislocations following earnings. Well, that is it for this month. Many thanks for watching. For those of you who run an open-ended portfolio, do you dollar cost average or buy the dip? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.